How's it going, everyone? Another day, another earnings week. These are the stocks to watch for the week of March the 4th. So, to kick things off on Monday, Sea Limited will be reporting, which is like the Singaporean Alibaba. Their main bread and butter is Shopee, an e commerce website where you can buy a bunch of different stuff. It kind of reminds me of Temu or Amazon. You can even buy a thong so you can wear it around the house. Actually, please don't do that, because I guarantee you, your dog Rocky will just bark at you non-stop. There's also GitLab, a coding paradise software engineers utilize. Another company is Stitch Fix, and their business model is subscription based. And I would even argue it's pretty interesting because they mail you new clothes every month based on your fashion or style preferences. And their business pitch is that you'll always have new outfits and spend less time shopping for clothes. If you're anything like me, I'm still wearing the exact same North Face jacket that my father bought for me back in 2005. So Stitch Fix isn't really my thing. And then another e-commerce startup, Wish.com. I have personally never purchased anything from Wish.com, but from visiting their website, I wouldn't be surprised if Amazon or Walmart eventually acquires them. So as for Monday, I'm not interested in any of these companies. Moving on to Tuesday, there's Box, which is a cloud-based content sharing platform. There's Neo, which is China's response to Tesla. And then there's Target. Target, I am very interested in because I think Target's going to report a positive earnings for Wall Street. Maybe it's my own personal bias, but it seemed like everyone was doing their holiday shopping at Target this year. And on TikTok, people have been sharing their experiences with how Target's loss prevention team has been working with the police to arrest a bunch of people that have been stealing from them. So Target is slapping back on that call out that they made last year where theft was a huge problem for them. And then there's Ross, which is a store where I got most of my clothes from growing up as a poor kid. In terms of prices, I find Ross to be really cheap, but their merchandising and shelves look like a tornado went through their store. Ross, TJ Maxx, and what you see for Thursday Burlington are all in the same line of business. They buy out of fashion, out of season, or clothes with flaws on them from the actual companies trying to get rid of them, because if they just store those old clothes in their warehouses, it increases their overhead costs and they can't make room for their new seasonal items. So they buy it at a very cheap price and then sell it to you. So you can actually snag a nice Columbia jacket for $20 at Ross instead of paying $100 from Columbia themselves. Also on Tuesday will be CrowdStrike, which is a competitor to Fastly and Cloudflare. They're all in the business of cybersecurity. Then there's First Watch Restaurant, ticker symbol FWRG. I am bullish on First Watch because they have their operations perfected and their margins are very high because their restaurants only serve breakfast and are closed by lunch. Because they only operate for a handful of hours a day, their payroll, food waste, and other expenses are kept very low. They also own the restaurants Egg and I and Bread and Company. If you have ever ate at one of these restaurants, then you know they are attracting a different customer base than, say, IHOP or Denny's. First Watch is doing breakfast differently and in a better way. I just really wish that First Watch paid a dividend, but they don't. And for a restaurant, that's really important to me, which is why I don't invest in Chipotle for the time being. With First Watch, I'm going to be passing up on them. Also, Ferguson is reporting. If you do any plumbing or electrical work, then you probably recognize this brand. My partner used to be in the HVAC industry, and so I'm pretty familiar with Ferguson. This is a pretty good company. It's a stable. Think of it as like an alternative investment to Home Depot or Lowe's. ChargePoint is also reporting, which is a company that is monetizing EV charge stations. We're talking about the physical assets, but also the software portion to run the meter properly. People that are bullish on the renewable industry are fan favorites of ChargePoint. Me, however, I don't own an EV. In fact, I just use my bicycle to travel around town. I wish there was a publicly traded e-bike company. Who wants to start a company with me? Then on Wednesday, we have JD.com, which is like the Chinese Amazon. What are my thoughts? I'm not interested. Just like after the Seattle Seahawks, which are my NFL team were eliminated from the playoffs, I tend to lose all interest in the playoffs. Another company is going to be EVgo, which is in the exact same business as ChargePoint. Then a couple retailers like Foot Locker and Abercrombie and Fitch. I remember when we used to wear Abercrombie and Hollister polo shirts with the collars popped. Yes, I was one of those guys. These days, Abercrombie apparel looks really different. Their identity is a brand that Gen Z resonates with. Also, Campbell will be reporting on Wednesday. Their ROI for the past 5 years is really low. However, their balance sheet and dividends seem pretty solid from my investigation. UNFI is a private food brands manufacturer, so when you see the store brand chips next to the real Doritos at Target or Walmart, UNFI is most likely the ones who manufactured and produced it. I can't say I am bullish on the private food label industry. If you're going to buy a food manufacturer, you might as well go with the actual brand that pays a dividend like PepsiCo or Hormel. Then there's Hamilton Beach Brands. One of my friends is a product manager at this company, and I'll admit, they make some solid kitchen appliances, but I'd rather be interested in Whirlpool for their KitchenAid business than, say, Hamilton. And lastly for Wednesday is going to be Korn Ferry, which is a consulting and headhunter agency. Korn Ferry is basically in the business of sourcing, hiring, and recruiting middle management positions like the directors or top-level dogs like vice presidents for a company that has a vacant spot. So if a Fortune 500 company knows they are about to fire their chief financial officer, they might outsource the hiring to Korn Ferry to find a suitable candidate or replacement. If you are a recruiter, I respect what y'all do, but it's an industry I'm not bullish on or interested in. I'm passing it up. Thursday looks really busy. Kicking things off will be Kroger, which was just denied a merger with Albertsons by the US government. Kroger is basically in the business of old-fashioned grocery stores. Prices tend to be a little higher than Walmart, but the selection at your local Kroger is usually better. Grocery stores don't really have a lot of growth, and their profit margins are very, very low single digits. So it's a company you should only look into if you want the dividend. I would not expect your capital to grow much at all if you invest in Kroger. With that said, if Aldi or Lidl was publicly traded, then I'd raise half an eyebrow and maybe a pube or two. Aldi is the way to go if you have a large family and a lot of mouths to feed on a budget. And when I lived in Germany, I can tell you that Aldi was an amazing experience over there as well. Broadcom is reporting, and that's a company where I was once invested into, but sold out with small gains. They're in the business of patents and producing key semiconductor chips. Broadcom is a very, very expensive stock because their products are in all of our electronic devices that utilize Wi-Fi technology. If Broadcom, ticker symbol AVGO, ever goes on a dip, I would see that as an opportunity to add them back into my portfolio. Then there's Costco, which at this point, I don't think they're going to miss their earnings. So why bother even keeping an eye on them for a buying opportunity? They're going to crush the expectations and then keep soaring to the clouds. Costco on a dip is like a myth or a legend. We have only heard about it, but it's rare to see it in person. Above them is ABM. ABM is in the business of providing janitorial services for corporate buildings, schools, and warehouses. And believe it or not, their balance sheet is actually really rock solid. Their numbers look fantastic. I think ABM might be a better value investment than, say, Republic Services and Waste Management, especially given the valuation differences. Then there's DocuSign, which baffles me to this day how they are able to thrive off a service where the consumer can sign a document digitally. It's actually hilarious. I feel like that type of technology should be easily replicated from Google, Microsoft, or even Apple. But perhaps it's because they own the rights to that digital signature footprint methodology. Good for them. Anyways, their stock is really beaten up, but for me, I'm not interested. I don't think they are undervalued at all. Maybe if they throw around the word AI a few times, it'll boost their stock price. And below them is Funko Pop. Funko Pop is in the business of selling those bobblehead looking toys that some people collect as if they're Beanie Babies. And I'm embarrassed to admit this, but I actually have one Funko Pop in my bathroom as decoration. But would I ever invest in Funko? Absolutely not. If you're interested in investing into toys toys, Mattel or Hasbro would be a better place to research. Then there's Grindr, which is a dating app for those that understand the question, are you a top or a bottom? Bumble reported their earnings last week and it was a hot mess. Their stock got punished by the market, and dating apps are not an industry I am bullish on. I just don't care. And if you know anything about me, then you know one of my preferred industries to invest in are restaurants like Domino's and Texas Roadhouse. On Thursday, we have El Pollo Loco, which is the Mexican Popeyes. Apparently, it tastes really good. I never had it myself, so I can't say otherwise. And then there's also Potbelly, which makes a mean sandwich, by the way. I am surprised how they are still in business because their balance sheet looks a little rough. If we are in the conversation of best subs and sandwiches, then call me a vanilla plain Jane. But I think Jersey Mike's and Which are the winners. Potbelly is good, but it ain't that good, if you know what I'm trying to say. Then you have Noodles and Company, which has a brilliant food idea of having a menu that offers Italian pasta, Asian noodles, and even mac and cheese. But terrible, horrific execution because not too many people would rate eating at Noodles and Company as an enjoyable experience. And why do I say that? Noodles and Company lacks flavor in almost every dish on the menu. I used to eat at Noodles and Company every week about 15 years ago, and over time, I slowly stopped going. All I'm trying to say is that they need to hire some people from Panda Express or Chipotle to get some flavor into their pasta. And to round out Thursday, there's Gap, which is a company I would avoid for the time being as they have lost their identity. They're going through a phase of trying to figure themselves out and trying to appeal to Gen Z. I think their best bet is Old Navy because the prices are not bad and their fashion is okay. And I suppose Banana Republic for the business professionals that have to dress up. When I was a consultant, I will admit I used to get most of my clothes from Banana Republic. Then there's Traeger Grill. Yeah, I had no idea they were publicly traded, but it's the company that manufactures those wood pellet grills. And let me tell you, if you slap some pork belly on a Traeger grill, your taste buds and maybe even your testicles might be overwhelmed. It is absolutely delicious. One day, I would like to buy a Traeger grill. As for the stock, most likely not. And finally, there is Vital Farms, what you see right there. They're in the business of selling chicken eggs and butter. No, I am not kidding. What differentiates them from the other eggs at the grocery store is that they claim to be ethical and humane to their chickens, feeding them nothing but the best organic food and treating them better than your wife's boyfriend. Personally, I think companies like Vital Farms will gain traction because Gen Z cares about stuff like that. But for older people like you, yeah, they probably don't care at all. So I have mixed feelings about their stock. I think it's a company that's going to be thriving in the next 5 to 8 years, but in the short term, I don't know. As for Friday, let me save you the trouble and say there is no company worth watching except for dividend compounders with cheese. And if you made it to this point in the video, a question that I have for you is what stocks are on your radar for this week? Which ones are you going to be keeping an eye on? Anyways, dividend compounders with cheese signing off. Stay safe.